Welcome to another episode of Financially Fit Radio. I'm Cory Sickles, representing the team here at Safe Harbor Retirement Group and Wealth Advisors. If you'd like more information about the insights on today's show, don't hesitate to reach out to us. You can give us a call at 614-760-0670 or visit us online at safeharboroh.com. And while you're exploring our website, be sure to check that radio page. There you can catch up on previous shows and even subscribe to our program through popular podcast like Apple Podcast, Amazon Music, Google Podcast, or Spotify. For engaging visual content on various financial subjects, feel free to drop by our YouTube page as well. Just search for Safe Harbor Retirement Group, and of course, you can watch the radio show right there from YouTube. You know, we're here to address any inquiries you might have or to arrange either an in-person or virtual meeting. And remember, all of our meetings are complimentary and carry no obligation. So your financial well-being is our priority. So let us know how we can assist you the best. Well, today we're going to talk about risk allocation. You know, Happy New Year, everybody. It's 2024, and there's no better time to start the year out to make sure that you're going to be allocated right, you know, to handle what's going to happen in the market here in 2024. Who knows? Could be up, could be down. But as long as you're allocated the correct way, you're going to be able to, experience the highs and the lows of the market. But before we kind of dive into that, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you? And Happy New Year.
Oh, Happy New Year to you, Cory. It's a great new year. We're starting off well. I think there's a lot of positives to look forward to this year. And getting our ducks in a row when it comes to our finances and our asset allocation is key. And I'm glad we're talking about that. But yeah, I think it's going to be a better year even than 2023. We ended 2023 on an up note, and we're beginning 2024 on an up note. You know, the Fed says they might lower interest rates this year. Most people think they will. I read that there's a 90% chance that rates will be going down this year. So that's good news, I think, for most people in a lot of ways anyway. So I think things are normalizing a bit, even more. I think things have been normalizing since the COVID situation. And I think each year we're getting a little better. We had a dip in 2022, but we've rebounded well, don't you think?
Yeah, I think we have. You know, the interesting part, Tony, is, because I work with clients, day in and day out.
Yeah.
And, they've already forgot about 2023.
Right.
Right. We had a good year in the market, and they've really already forgot about it. So, I mean, who knows what's going to end up, holding up here, the first few months. We have an election year coming here in 2024. I know it's going to be on a lot of people's mind about how to be able to handle that. But, more than anything, when you really step back and you look at what you really should do is every year, everyone should go out to make sure that, your risk matches on really truly how you're invested. As you get closer to retirement, you're going to obviously probably get a little bit more conservative. And of course, the younger you are, the more aggressive that you can be. And really what, for our listeners out there and our viewers, I would highly recommend that you go to our website at safeharboroh.com. We have a risk assessment link that you can click on, and it's going to ask you 10 questions. And those 10 questions are going to give you a score at the end. And what we can do with that is show you exactly how you really should be allocated within your investments. And just for example, Tony, if you come into our website, it gives you a risk score of 50, for example. Really all that tells us is anywhere between 40 to 60% of your assets, really should be invested in stocks. The rest of that money should be invested in something that's safe, right? Or safer. And, that's not necessarily bonds either. I think everyone experienced, back in 2022, not only was the market down, but, bonds were down double digits as well. And we know for many, many years, I think a lot of people thought, well, I got safe money in bonds. But even in 2022, bonds weren't safe as well. And the big impact on that was it's the first time we've really raised interest rates in years.
Yeah, it is. And so you have to look at all these factors. I mean, you talked about interest rates, you talked about, the inverted yield curve with bonds, kind of being upside down in 2022. things have normalized a bit, and hopefully that trend will continue. But you're right. Our listeners, our viewers, and your clients, I know, they're not looking back at 2023 at this point. They're looking ahead at 2024. And I think risk tolerance and where are your assets, how much risk are you actually taking on or have currently, and how much should you have moving forward is the big question. And get that out of the way right at the beginning of the year. And the way to do that, like you say, is work with somebody like yourself and take that risk assessment. It's easy, it's free. It's just like 11 questions, and they can find that at safeharboroh.com, correct?
That is exactly right, Tony. And, I want to give like a little analogy here, right? And I want, for our listeners and viewers out there, I really want you to think about your investments as a house, a fiscal house, right? And, when you're going to build a house, Tony, what's the most important thing that you can do?
When you're going to build a house, well, you have to have land and a good contractor and a plan. You have to have a plan.
You have to have a plan.
Yeah, you have
But
to
you
have
also
schematics.
But when you break ground, Tony, you need to have a foundation.
Foundation, yes.
That's right.
That's the most important part.
That's exactly right. If the foundation breaks, the house is going to collapse.
Yep.
Right. And of course, you need to be able to plan and do those type of things. But when you look at your portfolio, let's go back to that example of, you scoring a 50, for example, on your risk analysis. What that really kind of tells us, and let's just say you want to be 60% stocks, that you're within your risk tolerance. But then you have to worry about what are you going to do with that other 40%, right? And that other 40%, what you really want to do is you kind of want to use that for your foundation. And what I mean by that is you want to put that into something potentially where you're not going to lose any money. That's important.
The principal is protected.
The principal is protected.
Yeah.
Market goes up. Maybe you do participate in some of those gains. But at the end of the day, that foundation, we know it's going to be there. So that's why it's so important to put that green money, that safe money into your foundation. Now, the other 60%, now that's going to be that's going to be the rest of your house, your walls, your roof. You might have an issue with the roof, for example, right? You might have to come and get maybe some money out of that foundation or maybe out of some of your other investments. But at the end of the day, really what I want everyone to think about is, whether you have you might do a remodel, right? You might do a remodel in the house, change some walls and things like that. All you're really doing is kind of reallocating some of the investments that you actually have invested in the market. But at least that foundation's there. It's going to be there. It's going to be safe with your investments. And, our goal is when we start working with clients, Tony, is to find out what your risk level is, lay that foundation down. But, we still want to be able to, invest in the market, be able to get some potential growth and things like that. But we know, what you have in the rest of that house, it can go up or down based upon what the market's doing. But again, your foundation's safe.
Yeah. And that's key right there. You need to have a solid foundation, and the money that will be there every month and isn't at risk, that's your foundation, is what you're saying.
That's exactly right.
Yeah.
And and by doing that, now what you're also doing when we start talking about risk and allocation is now you're creating a diversified portfolio as well, right? You have some investments that that you're not going to be able to lose money in. Maybe you're going to be invested, in U.S. market, maybe some international market. We have some different types of products, but at the end of the day, you want to make sure that you're diverse as well. We have a chart that we actually, provide our, clients and prospects on an annual basis. And it lists about the 10 different types of sectors that we kind of focus on, whether it's U.S. or international or U.S. treasuries or gold or whatever that might end up being.
Sure.
But you can follow that throughout time. The S&P 500 is going to do good some years. Other years, it's not. International is going to do well. So what I'm getting to is not only do you want a diversification from how you're invested in the market, but you also want to make sure you're also diverse in some of those safe investments as well. Whether you're going to maybe put that into an annuity or maybe you put it into life insurance, put it into things that can actually grow. You don't have to worry about losing money in the market. And what it's going to do for you overall, it's going to allow you to have a nice diverse portfolio that's invested in multiple things.
Yeah. Yeah, and that's good. And it's that kind of diversity that you're talking about. A lot of people think, well, I'm very diversified, and then you look and all their money is at risk.
Exactly right.
They're diversified within the market, but there's always risk. So you have to have that balance of risk and safety. And what that is depends on your personal situation and where you're at on your time. The time has a lot to do with this too, your time horizon, right?
Time horizon's key. I mean, exactly. If you're 40 years old and you're not going to retire for 65, you can handle a 20 or 30% loss in the market, right? You can,
Right.
because you have time for it to come back. But, if you're 63 and you want to retire at 65 or 66, you can't lose 20 to 30% of your overall net worth, because now it might delay your retirement.
Yeah.
And if you're definitely retired, you definitely don't want to lose 20 to 30% of what you have in investments, because odds are you're taking money out of that. And that really kind of could potentially put you in a bind, where you might be in a situation where you have to take more money out than you should because of the market being down. And you can actually run into issues later on in life of running out of money.
Yeah. Yeah, and you don't want that, especially as healthcare costs increase as we get older. You have to have a plan in place, and you don't want to run out of money in retirement. So that's where risk allocation now comes in, right?
Yeah, exactly. Risk allocation is key for when we start talking about all that. And another thing, Tony, that I think that's also important too, is you don't want to be so, one way or the other either, right? What I mean by that is you don't want to have so much money in the market that your investments kind of follow that, but you also don't want to have so much money that's safe where you can't keep up with inflation, right? But, there's nothing wrong with having a percentage of your money invested into something where you don't have to worry about losing money, but you don't want to have all your money in there, because we know that, inflation is going to keep rising, whether it's, last couple of years, it's been 8, 7, now we're down to around 3%. But, we know things are going to cost more and they're going to keep going up.
Yeah.
So, if you want to make, $75,000, 20 years later, that's got to be about $115,000 in order to keep up with, have the same spending power, because of inflation. It's a silent killer. I don't think a lot of people take enough. They don't think about it as enough when they start building income plans, which is why an advisor can really help you out as well.
Right. Don't keep it all under the mattress is what you're saying, right?
Exactly right.
Because then you put $20,000 under your mattress, and in a year, it's no longer worth $20,000. You're losing money because of inflation.
That's exactly right. Yeah. I mean, we know it's going to keep going up. If you look at Medicare versus Social Security, for 2024, Medicare is going up over 5%. Social Security is only going up 3.2%. So, a net over net, you're losing a little bit of money, on the spending power. And we just know healthcare is going to keep going up as well. So
it is. It is. Well, hey, we're just over the halfway point. Why don't we let our listeners know how they can get a hold of you, Cory?
Yeah, no problem, Tony. For our listeners out there, just give us a call at 614-760-0670, or you can always visit our website at safeharboroh.com. And, here's what I would say more than anything else. We're really here to help and guide you. If you have a financial plan, we can be that second set of eyes and provide a second opinion. If you don't have a financial plan, we can actually put one in place for you. We can review your current portfolio to make sure that you're allocated the right way based upon your risk tolerance as well. So just give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And just a reminder, all of our meetings are complimentary with no financial obligation.
Yeah, that's great. And I know you look at where people are at. They take the risk tolerance, then you take their numbers, and then you look at their accounts and say, well, you came across very conservative in your risk tolerance, but yet all your money is at risk, or vice versa. You've got too much in safety or too much just sitting in the bank and not enough growth. So, and it depends on the person, it depends on their situation, their goals for retirement, and of course, their time horizon, when they want to retire, things like that. And that's what you take into account. And you don't have to do all that on your own. It's tough to figure out. A lot of people don't know the pitfalls to look for. And that's why they need a written plan in place from a financial professional and somebody they can work with going along to make changes as needed. And that's where you and Safe Harbor come in. Now, we're talking about risk allocation for the new year. What else do we need to know about risk allocation, Cory?
One of the things I think people really get emotional about is really what's kind of going on in the market and in the world, right? Obviously, within the last couple of years, we have, a war in Russia, Ukraine. We have a war going on right now, over in the Middle East. Inflation, interest rates, all this type of stuff. If you look in 2024 presidential election, we have all these, we have all these type of things that cause people to panic or really think about, how to really truly invest or whatever they want to do. Should I get in the market? Should I get out of the market? Whatever that might end up being. But, one of the things that we really try to do is when we meet with the clients and, every year we're going to redo the risk tolerance too, because things change. We want to make sure, based upon your current risk level, we have you allocated the correct way. That doesn't necessarily mean we're going to get you out of the market, right? We have a long-term plan that we put in place for you. We move that emotion from you over to us, and then we manage that. Those portfolios for you. During good times and bad times within the market. We might tweak it here and there, but we're not going to get in and out of the market and things like that based upon what emotional things that's actually taking place, right? So I just think one of the things that you really want to be able to do is, when you work with an advisor, we're going to be able to, we might adapt some of the way that you're actually invested within your portfolio based upon market conditions. That's why we do manage portfolios here, Tony. We have professional managers looking at what's going on in the market and be able to, make decisions, for our clients based upon that. But we always have that long-term outlook, not the short term, not that emotional, to get in and get out and things like that. I think that's really important because, you can run the numbers. We've seen all kind of numbers, when an average investor, when an investor goes out through there, they make a certain amount of percent. And if maybe if you're with an advisor, it might be 1% or 2% higher. I mean, you can go through and look at all those type of different statistics. But I think at the end of the day, by working with an advisor that is a fiduciary that has your best interests in mind, we're looking at the market. We're going to try to do what's the best or the right thing for you. And at the end of the day, what we're really trying to do is grow your portfolio.
Yeah. Yeah, and that's the key, is get enough growth that your money will last you as long as you want and hopefully leave a legacy. And risk tolerance has a lot to do with that as well. I think that people don't always understand the true balance. People think they're diversified, but then when you really look at it, they're not, right? I mean, that happens probably more often than not, doesn't it?
It does. And I can't tell you how many times they go, well, I'm 50 or 60% stocks. Then when you actually look at it, you're 75% stocks.
Yeah.
So, coming out of a year in 2023 where the market did well, you naturally got more riskier because your stock portfolio grew. That's why it's so key to start off 2024 to make sure you're going back and reallocating, lock in some of those gains that you made in 2023. Because we don't know what's going to happen in 2024.
Right.
I mean, anyone can sit there, half of the people that you read articles on, we're going to have another recession. The other half saying the market's going to go. So who really knows what's going to end up happening?
Yeah.
But you just need to make sure that you are diversified and you are invested based upon your risk level. And, speaking of diversification, what a lot of people always think is, well, I'm invested in US, I'm invested in international. I got some bonds, maybe I got some, real estate REITs or whatever those might end, whatever you are. But the one thing I don't think people really take consideration of, Tony, is you need to make sure you're also diverse from a tax efficiency standpoint.
Taxes always play a huge part in your asset allocation,
That's
don't they,
correct.
Cory?
They do.
Especially for retirement. People don't, I think that's the one area people don't truly understand. And I saw it with my grandfather after he passed, my parents trying to figure out their affairs. They have no concept of, oh, wow, there's a huge tax burden here.
Exactly right. So, there's three ways you can invest. You can put money into a IRA, which means you're going to receive the benefit of maybe lowering your taxes today. And that IRA could be a 401k or a 403b or a thrift savings plan. Then you have a Roth IRA. That's money you put in after tax, but it's going to grow tax free. And when you withdraw it, it's tax free. And then then we have what we call a non-qualified or like a brokerage account, which means you've already paid money, you've already paid taxes on it, but you're investing just like you would with a checking or savings account. However, you only have to pay on the growth going forward. So, when we work with a lot of people, the one thing I would say is we always see a lot more money into that traditional 401k, IRA or 403b or a thrift savings plan, right? So all that means, if you have $1 million in there and you're in a 20% tax bracket, for example, you really don't have $1 million. You have $800,000 because we know you got to pay the taxes.
Yeah,
and that's if taxes don't go up.
It's a joint account with Uncle Sam, as I always like to say.
That's exactly right.
Yeah.
I mean, and let's face it, the government loves that because they know as long as you live, you're going to keep paying taxes every time you take that withdrawal. Social Security's taxed potentially, depending on your income levels. Pensions are taxed. Your IRA or 401k could end up being taxed. So, you have to be able to make sure you're setting yourself up to make sure you have tax-free money or you're only paying on the gains going forward. And that's what an advisor can sit down and work with you on to make sure that not only you allocated right from a risk standpoint, but you're also allocated right, from a tax standpoint, because I consider that still risk because we don't know whether taxes are going to go up or down. But I can tell you this, they're not going to go down.
Right. Yeah.
So there's only a way, they could stay the same, but if anything, Tony, they're going to be going up.
Yeah. Yeah. Well, we know that, especially when the current tax laws expire the end of 2025 or next year, then we know taxes will go up after that, if not before. You never know what the government will do, but they're not going to reduce spending and lower taxes. At least not in my lifetime, they haven't. So, yeah.
And we're at the lowest tax rates ever. So
that's true.
There's really only one way it's going to go, and that's the other way.
Yeah.
So when we start talking about risk, of course, the other thing you want to make sure of is whatever you are investing in, make sure you understand what you're investing in. You need to make sure you understand, is your money liquid or is it not liquid? Are there fees in order for you to be able to pull money out of all that? There's so many people that actually come in and we visit with, that first or second time, and they don't know some of the investments that are actually invested in, and they're unaware that, if they pull money out, they're going to have all these, what they call surrender fees or fees to get out of things. So, that's a risk to you. So, one of the things we really strive and try to do here at Safe Harbor is we want to educate you. And part of that education is to make sure you understand what you're actually investing your money in, because at the end of the day, we want to do what's right for you, and you need to understand exactly how you're invested and what you're invested in.
Yeah. Yeah, I think that's the bottom line. You really need to understand your investments. And as you said, a lot of people don't. You don't have to figure everything out on your own, though. You just need a plan in place, and you need to be working with a financial professional who can help you with that and get you a written plan and help you each step of the way and look at the big picture. And that's what you do for your clients, Cory. So before we go, great topic today, risk allocation for the new year. Let our listeners know how they can get a hold of you to set up that no charge, no obligation consultation.
Yeah, for our listeners out there, just give us a call at 614-760-0670. Or you can always visit us online at safeharboroh.com. Again, all of our meetings are complimentary. There's no financial obligation. you don't have a financial plan, I recommend you get one in place. Start the new year out the right way. If you do have one, there's only one way that you can get a second opinion. That's by going to a different advisor. We're here to be that second set of eyes just to make sure that you have the right plan for you. So give us a call at 614-760-0670 or visit us online at safeharboroh.com.
All right. Thanks, Cory. And listeners, that does it for today's episode of Financially Fit Radio with our host, Cory Sickles.
Join us next week for another episode of Financially Fit Radio.